Welcome to The Explainer. Today, we're diving into a really fascinating story out of Pakistan. It's about a major standoff between the government and its business community that could have ended in total gridlock, but it didn't. Instead, it led to a pretty stunning policy reversal, and it offers a powerful lesson in how to get.
So, let's start with this question. What does happen when new rules suddenly give tax authorities these sweeping, almost scary powers to investigate your business? Well, that exact high-stakes scenario just played out in Pakistan, but the ending, well, it wasn't what anyone expected.
That's right. Instead of digging in their heels for a long, drawn-out fight, they actually sat down and negotiated. The breakthrough came from direct dialogue. And honestly, that's what makes this whole story so compelling and worth talking.
And the result of all that talk? Well, after some really extensive discussions between trade groups and tax authorities, the government agreed to walk back several pretty controversial budget measures. And we're not talking about minor tweaks here. This was a major course correction.
This quote from the president of the Federation of Pakistan Chambers of Commerce and Industry, that's the FPCI, it just sums it up perfectly. It confirms that the business community's biggest fears, especially about the tax authority's new powers, were actually heard, and more importantly, they were addressed.
So let's get into the specifics, right? One of the biggest points of contention was something called Section 37A of the Sales Tax Act. Businesses were, really worried that it gave the tax authority, which is known as the FBR, way too much unchecked power.
Now, to be fair, the government had a legitimate target in its sights. They were trying to stop a specific kind of tax fraud involving what are called flying invoices. This is where people use fake documents to illegally claim tax credits. So the goal was valid, but the way they went about it, well, it was creating some serious, probably unintended consequences.
Okay, so here's the before and after. The big fear was that the tax authority could investigate pretty much any business at will, which, as you can imagine, creates a climate of serious uncertainty. The fix? It limits this power strictly to cases of serious fraud, like those flying invoices we just talked about. And even then, an investigation can only start after a special committee gives its approval.
This new process, it's a game changer. It creates a really crucial buffer. So now, a simple allegation isn't enough to kick off a full-blown investigation. The case has to go to this new oversight committee first for a review. And only if they give the green light can an investigation actually begin. That's a huge safeguard against random or arbitrary action.
And who's on this new committee? This is the key part. Of course, there's a tax commissioner, but crucially, it also includes 2 nominees from recognized trade bodies. This is huge. It gives the business community a real seat at the table, making sure their voice is heard before anything drastic happens.
All right. Next up, there was another major win for businesses, and this one has to do with solving what you could call a cash conundrum. It involved a rule that, again, was probably well-intended, but it was causing all sorts of daily headaches for a lot of companies.
Just look at this number for a second, 200,000 rupees. This figure was right at the heart of a rule that was seriously messing with business cash flow. So what was the big deal with this specific?
Here's the problem. A rule, Section 21S of the Income Tax Ordinance, said that if a business made any single cash transaction over 200,000 rupees, they would lose the ability to claim half of that as a business expense. That's a massive penalty, and it was making day-to-day business incredibly difficult, especially in an economy where cash is still a big part of how things
The solution here was actually remarkably simple and, frankly, pretty smart. They didn't scrap the rule entirely, they just clarified it. Now, if cash from a sale is deposited directly into the seller's bank account against an invoice, it's treated just like a formal banking transaction. Problem solved. It's a practical change that gives businesses a critical workaround.
So while the National Chamber, the FPCI-SI, was celebrating these wins, another really powerful business group, the Karachi Chamber of Commerce and Industry, or CCI, was raising a flag on a different but still related problem.
The KCCI was really clear about this. They said, look, we fully support the government's efforts to crack down on smuggling. Their issue wasn't with the goal, it was with the method. They were worried that the enforcement tactics were ending up hurting legitimate traders.
So here's what was happening. Enforcement agencies were conducting these big raids in commercial markets. And the problem was, during these raids, legally purchased goods were often being seized right alongside the smuggled stuff.
This was causing huge financial losses and, of course, damaging the reputations of honest business owners.
But the KCCI didn't just complain, they actually proposed a solution. They urged the agencies to shift their focus. Instead of raiding city markets after the fact, why not go to the points of origin? Target the borders, the ports, and the airports where the smuggled goods are actually entering the country. It was a call for smarter, more targeted enforcement that protects the good.
So after all these negotiations, all these deals and different pleas, where do things actually stand now? What does this all mean for the bigger picture of Pakistan's economy?
This table is a great way to sum it all up. You can see that in each case, a major problem, whether it was the fear of unchecked investigation power or a heavy penalty on cash flow, was met with a practical, collaborative solution. It really does mark a clear shift from just blunt enforcement to a more nuanced approach to policy.
You know, the crucial point here, the real takeaway, is pretty clear. This wasn't some top-down decree from the government, and it wasn't some bottom-up revolt from business. This was a success story of collaboration. It proves that when government and industry actually commit to talking, they can find real, practical solutions to even the most tangled problems.
And that leaves us with one final, fascinating question to think about. Was this whole thing just a one-off, a temporary truce that was born out of necessity? Or could this collaborative model become the new blueprint for how economic policy gets made in Pakistan from now on? I guess only time will tell. Thanks for joining The Explainer.